Hello, everyone, and welcome to the Your Mark on the World show. I'm your host, Devin Thorpe, and our guest today is Todd Crosland, the CEO and founder of Seed Equity Ventures, one of our great sponsors. We're thrilled to have you on the show again, Todd. Thank you for joining me.
You bet. Thank you, Devin. Happy to be here.
Well, Todd, we've got an important topic to talk about today, and that's due diligence. You know, in the last couple of years, there have been some massive changes, really tremendously significant, at least for ordinary investors. These are big deals that people that have not been able to invest in startups now have the ability to do so through either Regulation A+ offerings or Regulation Crowdfunding offerings. And so we've got a whole millions upon millions of people who need to be learning about how to do due diligence before they make these kinds of risky investments. And I appreciate you taking some time today to help us talk through some of the key issues that people need to be thinking about. Now, working from a list that you provided, let's just talk about these one at a time. Your first point was that we need to look to see if there is a minimum viable product or a prototype with proof of concept. Why is that important?
Well, I think we've talked in the past about the many companies that we look at each month and each year. I've got a little bit of feedback on this, Devin. Do you hear that?
I don't. I apologize. Let me mute my microphone and see if that'll help.
Okay, that seems to. Can you hear me? That seems to be a lot better. But if we look at the opportunities that are available for investors, and I look at kind of our own portfolio and the companies that we have invested in or raised capital for, there's a myriad of opportunities for investors to look at. And so I think as we start this, the one thing that I would advise is to take a portfolio view for these investors. And so if they're going to set aside X amount of dollars for investing in early stage companies, look at spreading that amongst 15 or 20 companies. And so now you've got your portfolio. This is your risk capital. This isn't your 401k. This isn't retirement. This isn't to make your mortgage payments. This is a sliver of your investment portfolio that you would allocate towards this sector. And so now you've made that decision. This is risk capital. I'm going to allocate it amongst 15 companies. Then you can go through as you look at different opportunities.
Todd, we seem to have lost you here. I'm hoping that connection will be restored momentarily. But while we're waiting, I'll just say I think that was a great point that you made, that investors who are looking to start investing in startups, whether they are affluent, accredited, wealthy, high net worth, or ordinary investors, in any case, they should be looking to invest, as you described it, a sliver of their investment portfolio in startups, as that is really a risky part of the asset spectrum, and so you don't want to be overweighted in assets that could just blow up on you. So that's a great point, Todd. I'm hoping that we can get you reconnected here quickly. I'm not sure what you're seeing on your end, but it looks like you dropped out so you can reconnect. I'm hoping that's the case. But Todd, I think these are great points that you made in terms of due diligence. The first key being to take that portfolio approach. Next, I think we wanted to jump in and take a look at the issue of there being a prototype or a minimum viable product. often call it MVP these days. That's, I think, a really vital consideration, and I look forward to getting your further thoughts and comments on that. So Todd is having trouble reconnecting, it looks like. So let me see if we can get Todd back on here a little bit. I think we'll be able to do that one way or another. Hang with us, folks, for just a minute. This is the joy of live broadcasting, is anything can happen. And today we lost Todd just when we wanted him. So we'll see if we can't get Todd back into the conversation. I'm optimistic we can, and then we can continue the discussion. So I appreciate you hanging with us there for a minute. I've re-invited Todd, and I think we'll get him back on the line here shortly. It'll just take a minute, and then we'll be able to continue. I may just dial him up on the phone here and see if we can get him coached through logging back on. So hang with us. Watch me call Todd as we work through this. Todd, how are you, sir? Okay, that'll work great. I'm sorry you lost your Wi-Fi. It's terrible. So we're still live, such as we are. So we'll want to get you rejoining the Hangout as soon as you can. You can just do it from your phone too. If you want to just grab that email with the link on your phone, just click that and it'll take you into your app right there on your phone if you've got it installed. And I think we did this once before. I think you've got it installed. Okay, there you go. You're good. Can you hear me, Todd? I can't hear you. Oh no, what's going on? Can you hear? I can't hear you. Can you hear me? Not if you can hear me. I don't think you can hear me. Okay, say something. I can't hear you. I can't hear you and you can't hear me. This is not going as well as I would have hoped.
How about that?
Oh, there we go. Now I can hear you.
Okay, great.
Okay, so we are in business. So we are still live, and I will edit a little bit of this out before we after we get done. But we are still live, so we should jump into it again. Are you still getting the feedback you were getting before, Todd?
No, this is perfect. This is
okay,
perfect.
So the question I'd put to you then is, let's go back to the topic of a minimum viable product. Why do you think it's important to have a prototype or proof of concept available before we invest?
Well, I think there needs to be some heavy lifting done from the entrepreneur and the founder, where they've invested their own time and effort and capital to get to a point where they do have a minimum viable product and they're ready to launch, or they have launched. And so I think it at least getting to that point, you can make a more educated guess on your potential investment. And then I think your odds of success versus, lots of people have lots of ideas, which, I applaud, but it's nice when those ideas are put to, through the rigors of trial and error, and they actually have their product or service, up and running.
Yeah. Well, the next point you offered was that you want to look for initial traction with active users. Why is that important, and how do you find that?
Well, so what we're looking for, and we think it's good for other investors to look for, is to find companies that, they don't maybe necessarily have revenues yet, but maybe they've launched their product and they have, 3 beta companies that are using their service, or they have, it's an app or web-based product when they have, 5,000 users that are actively using their product, and they're growing, X percent per week, per month. And so it's easy to, get excited about somebody's dream and whatnot, but is there somebody in the marketplace that actually thinks that there's a use for their product or service? And so we think getting validation in the marketplace is important. And with early customers, with companies that we talk to, early customers, we like to talk to the company's early customers as well, and get their thoughts, not coming from the founder, but coming from the customers themselves.
Oh, that's a great tip. Great tip. Now, you next list, are there at least 2 full-time team members? I thought that was a great insight. In my experience with solo entrepreneurs, that's sometimes a tough gig. Why do you think having a team of at least 2 is important?
Well, and most of the companies we invest in, there's, there could be 5 or 6 or a dozen even already. But I think at least 2, there's heavy lifting to do with any new venture, and, having a technology co-founder that can help with the technology and with the launch and the development, I think that's key. But then you're going to need, financial and marketing type person as well. So I think having at least two founders makes a lot of sense, and I think that's what, as investors are looking for opportunities, that's something that they should check off their list.
Sure. Another tip related to the team is you suggest identifying whether any of the founders have been part of a successful company launch in the past.
Sure.
That sort of precludes first-time entrepreneurs. That seems harsh. I'm sure it seems harsh to some people. Tell us about what your experience is with that.
I think all of these aren't hard and fast, but they should be taken collectively. And if there's 12 items on our list that we are going to vet, and we're really comfortable with 8 of them, and we think that there's such a compelling reason to invest in this company, we can do that. But I think if you find founders that have had success with a previous startup or a previous company, I think that bodes well. So even if it wasn't successful, what a founder can learn from a previous experience, dealing with investors and shareholders, launching a product, the hours it's going to take, and the commitment that it takes. We think that experience is really important to have.
Great. Now, the next question you suggest is, was the team able to raise any funds prior to this raise? I think that's a great one. What's your experience that leads you to think that's an important factor?
Well, I think part of it is, so they've gone through the incorporation process. They've got a legal entity, and if they raised funds in the past, we'd like to review their cap table, and and even potentially talk to some of those investors. How were you treated through this process? And then we also look at what valuation they raised money at a previous round. And so I think all those things are kind of quantitatively put together as we decide whether we want to move forward with the company or not.
Now, your next tip is, what is the payback period on the investment? How do you evaluate that?
So at early stage, the area that we're investing in, it's not like a real estate investment where they're going to put 20% equity into their project and they're looking to refinance it or sell it in 8 years. So I think more than anything is, it's hard to quantify what the payback would be, but you hope to find, entrepreneurs and companies that will have interest for other companies. I think that the typical or kind of the classic outcome that we're hoping for with these companies is that they'll be acquired by a larger business. And so, do we think that this team can build this into in such a manner to gain interest from larger competitors or companies that would want a complementary product in their portfolio?
The next question is related to that, and it's when you have you calculated when you are expected to see a return on investment?
Well, I think what you want to do is, and I think what we're looking at this is, there's some people that we talk to that it might be a nice company, but this might be a nice company where they get 4 or 5 employees and it's a lifestyle business where I can earn $150,000 a year running this company, and that's a nice livelihood, and I'm happy to keep it this way and not worry about selling the business. And so we like to have the structure such and the commitment from the entrepreneurs that we're going to grow this business in such a way that there'll be interest from outside investors or outside companies in the future.
Now, next question is the entrepreneur's marketing plan realistic? That's a great question, but how do you evaluate that?
Well, I think it's so we would look at if they're in a given industry, we would look at what competitors they have in the industry. We'd look at Crunchbase or AngelList to see if they've raised money in the past, who are the investors, and then a lot of it is how likelihood is this team able to achieve their plans. And sometimes you'll see plans where we're going to do $100 million the first year, and we haven't done anything, but we're worth $20 million today. So I think somebody that's realistic, that's had mentorship and even have gone through an accelerator, they're going to have a better handle on expectations and what they're going to do in growing and ramping their business.
Yeah. Now, the next question is really one for some introspection. I think it's the question for the investor. Do you fully understand the industry? And I think that's an important question and an important thing for entrepreneur or investor to take that moment and say, do I really understand what I'm investing in, right?
So I agree. I mean, there's some companies that we've talked to, they seem really interesting, but our team would have no expertise and potentially no value added consulting that we can give to the company. So I think finding companies that you're interested in just in your personal life, if you're an engineer or whatever field that you're in, if you can add some expertise through your investment process, we think that's important versus investing in something that's completely out of your skill set or your knowledge base. We don't think that probably makes a ton of sense, because you'll have to rely wholly upon what other people are telling you.
Now, the next question I think is just vitally important. One of the keys is, have you looked closely at the competition? You've probably heard entrepreneurs say they don't have any competition. It always scares me. What's your take on this?
Well, I think, and we've heard that as well. And I remember one company we met with this last year. They said they were so excited about their business model because their only competitor in this model in this business would be Microsoft. And so talk about the 800-pound gorilla.
Yeah.
That they could price them out of existence. And so I think that small nimble companies can compete with these big players occasionally, but I think finding a segment where there could be a competitive advantage, and maybe it's not against the 800-pound gorilla, might be I think, a good strategy for investors.
Yeah. Another question you listed is, have you looked, or how many investors are in the cap table? Why do you worry about the number of investors in the cap table?
Well, I mean, so that's somewhat changing with the new regulation as well. So you have Reg A Plus, which could have several thousand investors, but along with that, you'll have a registered SEC transfer agent to keep track of the cap table and all the investors. But I think, more than anything, when we look at the cap table is, there was one company that we looked at, they really hadn't launched a revenue product yet. And over the last, 5 or 6 years, they'd raised, $11 million at different valuations from a few hundred investors. And so none of those investors were getting a return on their investment yet, and now they're out raising more money. So I think the company was really good at raising money, but not really good at executing a plan. So I think this is one of the components that you'd want to look at is, on the cap table, investors, do they come in at a $1 million valuation? Then the next investors came in at a $2 million valuation. How many of them were invested at different levels? Were they sophisticated investors, or were these aunts and uncles? So I think you can gain information from doing that.
Sure. And the next question you had is, how does the entrepreneur plan to use the money? I think that is a great insight. You've got to understand that, right?
So use of proceeds, and is it realistic? And if they're saying, well, I'm going to pay myself $250,000 a year, and so I'll have 2 years worth of run rate on this $500,000 raise, that's not what we want to hear. But I think somebody that's been thoughtful and, they're looking at marketing or adding another, couple of engineers, and we think just being thoughtful about their use of proceeds, and then is that realistic as well?
Then another question you asked is, what is the startup's burn rate? And that too, very important to understand.
Sure. And we've seen lots of examples with, a company that's raising $1 million and they have a $250,000 a month burn rate. And so, and maybe they're 2 years away from break even. And so this $1 million they're trying to raise will only, last them for 4 months, then they're out raising money again. So I think, knowing what their burn rate or, their net cash flow is important to see if this investment will really get them to, to their Series A, where they're going to raise, a significant amount of money.
Now, Todd, these are all great questions and great insights. I think one of the one of the keys is to use the process of obtaining these insights to better understand the management team. Don't you think the management team is a vitally important part? And we had a few specific management team questions in there, but all these questions give you an opportunity to get to know the management team.
Correct. And that's so you've heard it your whole life. You're betting on the jockey and not the horse, but you're betting on a couple of jockeys. And that's it. One, they need to get along, and they need to have demonstrated their ability to work together. And there'll be ups and downs that they'll face, launching their business. And so, getting the right people on the bus, so to speak, is key.
Yeah, fantastic. Well, Todd, I really appreciate you taking the time to be with us today. I know we've asked you before. Tell us again how people can learn more about Seed Equity Ventures and connect with you.
Sure. So the website is just seedequity.com. If you want to email me, happy to respond to any emails. It's crosland@seedequity.com.
Fantastic. Well, Todd, thank you very much for joining us today, and we appreciate all the time you give us.
Great. Devin, thank you.
All righty. Let's do some good.